Thank you for throwing some of the answers into our intro question we have here. We're going to start in about another 2 or 3 minutes. And while we're waiting for everyone to log in today, I just want to do a brief introduction of who's going to be joining us and what we're going to be talking about today. So today we're going to be joined by several of the talented agents here at the LAD Group at Cascade House and Sotheby's Realty. We've got Alice Fairbairn. She has been with our team for many years, and she's an exceptional agent. She's a master negotiator, and glad to have you here with us today, Alice. Thank you. We've got Eric Chapin. He's been on our team for a while. He has a long tenure in this industry. He was an appraiser for many, many years, and he has a lot of great insight, both on housing and the outside factors affecting it. And then we've got Jacqueline Oakland. She's uber talented, and she has represented a lot of buyers and sellers with us at the LAD Group, and she's got some great insights for us today. So they're going to be each adding their input as we go along. My goal today is to have this last no more than about 20-25 minutes at the very outset. I'm going to try to be very respectful of your time, and if you have any questions, please put those in. We'd love to address those today. So, and we've also got Jamie Griggs hiding in the background. She's our talented marketing director, and she's going to be throwing out a few polls today as well. But Jamie, can you share the results of that first question? Is that shared with everybody?
Sure, yeah, people should be able to see that. And if not, I'll read the answers here. We have about 17% who say fear, 33% opportunity, 17% threat, and 33% scarcity.
Yeah, so there's a lot of different emotions circulating in housing here in 2023. It's been an absolute wild couple years. I'm sure all the other agents here on my team will attest. In February of 2022, the world in real estate as we know it ended, and we had to reassess what housing meant for our clients, and how housing played a part in Ben's future. And it was fun to see that hold strong through the pandemic. And then we had really an unprecedented rush of migration and buying activity, which has caused some real issues in our market with affordability and scarcity and things like that. And now that we're on the backside of this pandemic, we're dealing with some of those unwinding factors, return to normalcy on the back of hyperinflation and some of these things that are going on in the Fed. So if you're not sure how to feel about housing, join the crowd. We feel that we have some really good data points to put your emotions a little bit at ease. Hopefully you can put some data behind your beliefs so that you can create a plan that allows you to make a wise investment, or at least sleep at night here in Bend, Oregon. So we're going to get started with that. And what I'd love to do is probably pass the mic over to Alice. And you've had a long history in this. Could you start with kind of what's happening with mortgage rates and really how that's interplaying with what's happening in housing?
Yeah, definitely. So obviously in Q4 of last year, we saw some pretty big spikes compared to what we've seen in previous years. I think we all got used to the historic low 3% mortgage rates. And that's just not, if you look at the 100-year average of mortgage rates, that was at a literally a historic all-time low. And so we saw that pretty big spike in Q4 of last year, and it kind of continued on through Q1 of this year, and we're finally starting to see a little bit of recovery and relief from that. One thing that I think is interesting that I read, generally speaking, it takes people about 18 months to get used to the new. And I think, ultimately, when stuff went from 3% up to, for some folks, it was 8-9% for interest rates. And now we're starting to see that recover back down to the 5.5% or so. I think there's a little bit of mental relief that's starting to come for folks as we move into Q2 of this year, where it's just starting to feel like the new normal, and 5.5 doesn't feel so scary like it did, in Q4 of last year.
But in conjunction with that, obviously the mental association with saying, hey, 5-6% historically is a good interest rate. But there were some real effects on that because we've had, we're now on, up since about 2010, 2011, we've had year-over-year price increases above market or historical averages. So we have some real affordability issues in that. And we were getting away with that with some of these lower interest rates the last few years, but it really brought it to a head here in the last few years as interest rates doubled.
Yeah, it really did. I think that, as interest rates doubled and we saw, pretty significant increases in housing prices the last few years with the pandemic, it really crushed affordability for a lot of people. I think, a lot of people could get away with the monthly payments when it comes to their debt to income ratio when the interest rates were super low. And now that prices went up, interest rates went up, it really kicked a lot of people out of the market. The millennials have been very affected by this. It's actually priced out a lot of millennials and it's kind of forced them to keep renting. So starting to see a little bit of recovery from that with interest rates has been super helpful. On a positive note, affordability has improved for the third consecutive month. So the trend is, starting to look like things are stabilizing, and hopefully it's going to put us into a trend where, housing stays affordable for everyone, becomes more affordable for those that couldn't buy as everything kind of came to a head.
Yeah, so it looks like we've got a graph here on monthly mortgage payments. This is a US average, but this really shows what happened. If you go back to January of 2021, average mortgage payment 1,000, and we doubled that in October of last year. And obviously, we've even have higher prices and higher mortgages here in Bend, but I'm sure you felt this on the front lines, right? With buyers just simply able not to pull the trigger, or simply not able to pull the trigger Q3, Q4 of last year.
Yeah, it was near impossible for some people, especially if you couldn't fit into the, standard mortgage box of being able to get a normal conforming loan. I think it was one, impossible for people, but two, a little bit scary when they started looking at monthly payments compared to what they were looking at, the previous years for the same house. I mean, it was astronomically higher. And so we were either looking at something that was a lot cheaper in terms of the home and it wasn't quite the right fit for their family, or they just had to sit on the sidelines.
Yeah, perfect. And as we go forward, Jacqueline, Eric, if you guys have anything to input, please let's have an open, real discussion in front of everybody about that. I'd love to hear your input. And then likewise, client or everyone that is listening here today, please throw questions and answers or chats and we'll answer those in real time so it's relevant to everybody. And then I'm going to go ahead and flip ahead to the next slide. This shows, especially how much of an effect these interest rates had, especially here out west, right?
Yeah, definitely. It's nice to see the national trends, kind of moving into the direction of, median home price being able to be or like median household income with qualifying income for your mortgage. A lot of people are kind of getting back into the ability to buy based on median income, but the West has remained kind of the most unaffordable. So I think as we start to see mortgage rates stable out and, hopefully home prices stabilize a little bit, I think that should hopefully help the West to, kind of move in a better direction. On a positive note, the West region did rise by 6.9% in affordability this last month. So I think we're trending in the right direction at least.
Yeah, and that's really a combination of some price pullback with the lower interest rates. And, I'm feeling that there's going to be some buying opportunities here in the next quarter that we haven't seen in several quarters, if not several years. Are you guys seeing that, Jacqueline, Eric, as well?
For sure. Yeah, I agree. And I think a lot of it too is like you said, the pent up buyer demand. A lot of people have been on the sidelines, kind of not wanting to make a move with higher interest rates or with, a low mortgage rate that they secured maybe before. But some of that is, I think, definitely starting to shift. And even at our Sotheby's meeting today, I'm hearing a lot of buyer wants and needs and a lot of upcoming listings and homes on the market. So it's definitely feels like it's picking back up.
Great. And then, to close on this, and Eric's going to get to this in a few slides later, but what we're, not everyone's kind of totally aware of how mortgage rates tied to the Fed and the 10-year Treasury, et cetera, et cetera. But in synopsis, with what's happening in the financial markets right now, it's actually going to help drive down mortgage rates, which it actually creates some additional buying opportunity. And so we're kind of out of sequence, and we're almost converse or inverse to what happens with the overall economy sometimes with housing. And this is one of those times where the more troubled the financial markets are, it actually might drive us in a direction of lower interest rates. And we can get to some of those details later. But with that, Eric, why don't we jump over to you? We're getting a lot of questions about pricing. Everyone's just, confused about what's happening in pricing. And, let's discuss a little bit more about that. Jamie, did we have a poll regarding the prices right now as well? Perfect. And so, Eric, while you get started, if everyone could just take a look, I just want to get kind of everyone's gut feel on where they believe housing prices are going the rest of the year. And that'll help us inform our discussion here in the next few minutes.
And while we're filling out the poll, we do have a question in the Q&A. Jeff asks, how common are rate buy downs in the Bend market?
That's a great question. I was just going to mention that. And I'm not sure, Eric, if you're going to speak on that, but I think following Alice's talk about interest rates, I think that is also going to, we're starting to see more buyers get more comfortable with the concept of a seller rate buy down, in which the seller credits some cost to their closing costs or an interest rate buy down, which can bring that, 6.5%, 7% quite a bit down by 1.5 points sometimes. So I think that is crucial in a market with high interest rates. And that's something I definitely, advise my buyers to consider. Yeah,
Jacqueline, and could you just, for those not familiar with the rate buy down, and what does that mean? If interest rates right now are at 6%, what does a seller buy down mean, and how does that happen?
Yeah, great question. So in our market, I mean, obviously this depends on how much you're putting down, how qualified you are, whether the home's been on the market 100 days or 4, right? But so say there's a home on the market and you want it and you're qualified for it, and you don't want to increase your closing costs, your down payment, you want the seller to handle that. Essentially what you would be doing is financing the rate buy down. And we had one of our lenders who we work closely with a few weeks ago was essentially explaining that because interest rates are so high and lenders are predicting that they're going to fall, there's a lot of liability and costs for underwriters right now to carry that. So they're charging it up front. So in order to essentially recoup potential losses in the future, you can buy down the rate and they'll secure a lower rate for you. So what I suggest with my clients is, if it makes sense, let's offer 1 to 2% over asking or over where their offer price would be, not necessarily asking price, right? If it's been on the market a while, you may be asking price, maybe under, but over the net price of the home, and then ask the seller to then credit that back. So a lot of lenders call it a 2-1 buy down. So 2 points for a 1 point rate buy down. Again, that can definitely change on your lender, your financial institution, or what rates are doing. But I have seen that it really can help that rate, drive down that rate if you're going to look at a longer loan.
Yeah, so if you have a longer holding period, 3-5 years beyond, some of those rate buy downs might make a lot of sense right now. So thank you, guys. And so let's jump over to Eric. And with that, the results of the poll, 67% of you believe that it's going to be flat prices this year. 22% of you down, and one of you says up. So no one thinks it's going to be a strong up or strong down, but more of you feel that it's going to be flat or down, which is kind of what we've seen. So those are good answers. And Eric, why don't you take it away? What are we seeing?
Sure. I mean, in general, there's some key factors in terms of big picture, and then the kind of regional impacts of what we have going on in central, the Northwest and even Central Oregon. The values themselves have certainly I mean, you know, based on the next slide, you know, is the 2.5%. I mean, we have seasonal impacts across the country, and in terms of, you know, winter time, it slows down a little. We have those kind of impacts of a little less inventory, a little less demand. But as we've seen in the last like 16 to 18 months, you know, we had a kind of slowdown in August and September of 2022, and that was because that was kind of the beginning of when interest rates started to go up. It kind of peaked out actually in late October. So we saw things kind of calm down a little bit in October, November, December, but being around the holidays, it still was kind of just simmering. And once we turned the corner of Q1 of 23, things have really picked up and across the board, whether that was demand on properties, inventory, and you know, you see that in this graph right here is that you know, we are flat, but we're still seeing activity, strong activity, and you know, part of that, you know, falls into you know, the fact that as Jacqueline and Alice just mentioned, as rates have gone up, buying power is going down. So even though somebody is still spending a similar amount of money, what they can afford is a little bit less. So those are also factors playing into, you know, what is, I mean, 2.5% is, you know, it's still a little bit of a change, but in the big picture, it's pretty typical.
Yeah, so let's talk about what's happening here in Bend. Where are we at? The data that we're using is for single family homes average sales price. What are we seeing?
I mean, it's in, you know, it's kind of in line with what we are seeing year after year. I think one of the key pieces of information to point out is, you know, if we were to go and look at the 1 year previous to that, you know, we're still kind of working our way out of the end of the COVID kind of, you know, the COVID numbers, which in my opinion is super important. You know, yeah, we are down, although I will say, I looked right before this, you know, I got on right before this webinar, and the numbers that we were seeing out of December were, you know, in terms of sales and inventory levels, were pretty flat. Once we hit January, we went from 84 sales in January, 115 sales in February, and 125 sales in March. But here, to me, is the kicker and the change is currently there's 280 properties under contract right now, and there's 260 listings. So we are seeing what I mentioned earlier in terms of, you know, we're seeing unseasonal differences in our market where we would usually see this in like May, June, and July. We're seeing it in the middle of the spring. And we're also seeing that demand early. So there's some things that aren't typical, but that are certainly showing signs of improvement, like big picture.
Yeah, and a lot of the data that we're using is trailing data. And it was really pronounced in December, January, February, which is why if we use a rolling 3 months average data, we're showing ourselves down 8.5% year over year. But historically, now this is something we've gone over in some of the other webinars, there's usually about a 6 to 8% peak to trough pricing every year. Usually prices peak in April, May, June, and then they pull down in October, November, December. They're usually about 8% less, and that's the seasonal average. What Eric was talking about is that we had the unwinding of some of those exceptional appreciation rates of 15, 20, 25% during the pandemic. So it wouldn't be surprising, even in a normal market, to have some softening over the winter, upwards of 8, 10, 15%. But we're already starting to see firming up. So the sky is not falling. In fact, in the last couple of weeks, last month or so, we've seen an uptick in pendings and really firming in prices, which is really in line with what we're seeing nationwide. This also reassures me that Bend is a more mature housing market. Back in 2007, 2008, when Bend crashed, the world, you know, the US housing economy crashed. We were a byproduct of speculation, oversupply, non-diverse economy, et cetera, et cetera. And we crashed about twice as large as far as a percentage than the overall national market. This time, we're more robust and we're more, we're more buffered from those swings that we saw in the past. Are you guys seeing that in the front line as well?
Yeah, absolutely. I'd love to touch on one other thing on this topic as well. So one thing I think it's really important for buyers to understand, and even sellers really in this market, what we're talking about in terms of these changes in numbers are average sales price, right? So there are different sectors of our market that are outperforming others. I think that when you start to get in the weeds a little bit with the data, it can give you a little bit of sense of false security in certain price points and that actually more affordable, 400 to 600 price range. If the house is priced well and it's move-in ready and there's no major location issues, I'm still seeing multiple offers and I'm still seeing stuff go above list price. So
Yeah.
I think it's important, one, when you're listing your house, to list it right because it'll still be, competitive. But when you're buying, don't get stuck on list price. It really is, based on market, really diving deep, doing comparable market analysis and understanding that it can still be competitive, I think is important.
Yeah, I agree with that. And then this is a perfect segue. I want to go over to Jacqueline a little bit. And there's a question by Drew. Thanks for sending that in. Saying more and more companies are asking employees to return to work. Do we foresee this impacting remote workers based in Bend who may consider so? Yes. To the degree that some towns are, no. So what we're seeing is that Bend has proven to be more sticky than a lot of the Zoom boom towns that we saw in the pandemic. There was a lot of people that fled the cities and did lifestyle moves to small markets because they could work remote, et cetera, have a great lifestyle. What Bend is proving is that we're robust enough that if someone gets called back and they don't want to go, they can generally find a job, or they can make it work, or it's sticky enough, it's a diverse enough economy. And what we're seeing is a much less of a return to workforce in the cities than some of the other smaller, more resort towns like Bozeman, Montana, et cetera. So we are seeing some of that come, but not as much as we had expected, to be honest. Maybe we're actually kind of hoping for a little bit more of that this spring to bring some inventory to market, but we're not seeing a lot of that. And with that, let's jump over to Jacqueline. Why are there so few homes for sale right now?
Yeah, this is a great question and one that we as a team talk about a lot. I hear it from my buyers and I am seeing it out there all the time. So just to tag on to what Eric was saying, I know that you just sold a home very quickly before it even hit the market. And today I found a place for a buyer of mine that has not hit the market yet, that is already expecting an offer. So it's kind of crazy, but the last, 2 offers I've written have been multiple offer situations. And I do think it's because inventory is low, because there is this pent up buyer demand where buyers, were not actively looking for homes. They wanted to wait on interest rates, whatever the case may be. But now it's starting to build where, we're almost to the end of the school year. People are trying to get into this new place. So, okay. So why is inventory low? So inventory has been very, very low the last few years here. And we saw a huge increase in what we call pandemic buyers. So the big city buyers who were living in a city that was shut down during COVID and that maybe made their move to Bend for the lifestyle, to relocate their families, these huge life changes that I felt a lot of my clients were maybe a couple of years out, maybe not like a right now kind of thing. And then the pandemic was certainly an anomaly of the norm, right? It was something that really shook that up. So with all of the influx of buyers in the last few years, all the people who purchased homes, we have to think about that record being set and not the norm. So typically homeowners, the duration of a home ownership, I was looking at numbers, the median across the US is around 13 years. The average is around 8, but I found a statistic that, towards the end of 21 and 22, home sellers, the average duration in their home was around 5.8 years or something like that. So essentially that's showing us that it's not 1 year, it's not 2 years, it's not 3 years. So if we had this huge influx of new homeowners and home sales in the last few years, that's a big part of it, is that, it's not typical for somebody to buy a home every 2 years. So with that, all of these home sales that occurred in the last few years are not going to turn over. So I think that's
Oh, no, so sorry, I didn't mean to step on. So that ties into kind of two other things. One, we've talked about how there's been a shortage of homes built from 2012 all the way up to 2020. So we already went into the pandemic with a historic shortage. Then it fell into what Jacqueline talked about, where we had unprecedented migration, and that COVID was really an accelerant in life plans. But then, Jacqueline, are you also seeing the people that have all, in 2019, 20, 21, 22, who got 4.5, 3.5, 2.5% loans? Are those people looking to sell their homes again right now?
Yeah, good question. I was just about to go there. So we're going to sound like a broken record on this Zoom, but interest rates have completely changed the climate of the market. And so with that, if you have a 2, 3, 4% rate, and now rates are at 7 or 6.5 or 5.5 if you're lucky, that is going to change your monthly payment. So with that as well, I'm seeing a lot fewer what I like to call like lateral moves, where it's like I would like to be in this school zone, or I would like another bigger garage or more property, and more of, okay, well, what is a make me move deal? Is it a want, or is it a need? So the needs are always going to remain, retirement, moving for jobs, moving for family situations, upsizing, downsizing. But I think that we have seen a huge decline of those moves that are in town. I want more acreage. I want this. I want this. And with that also, because people aren't willing to give up their low monthly payments, their low interest rate. But with that comes the increased equity, because values have increased quite a bit. And I'm not talking the last, month or 6 months. I'm saying if you purchased in 2020, 2021, you are looking at a pretty nice equity on your home. And so I have also seen an increase of those buyers who are like, I would like this, just either take out equity or take some cash that they would potentially put into a new home, and redo the kitchen, or that kind of thing. So yeah, let's see, months of supply. So the other thing is, on a macro level, there are all of these pandemic issues, interest rates, all of that. In terms of Bend, I do think it's worth noting as well that I feel like we had a pretty harsh winter, and our typically in Bend, I feel like our springs a little bit sooner than it has. And so I think that we will have more coming in the next few weeks. I can feel it. I'm seeing it. And the sun's starting to come out. So that's great. But I do think that, if you're waiting to see 2021 and 2020 and 2022 sales, it's just not realistic, because it's not, homes don't turn over as quickly as that historically.
Yeah, and then we were talking before this about kind of the historical perspective, and that's the slide we have up right now, because a lot of people are saying, hey, prices are going to crash. And we've talked about this in the past, that housing, somewhat goes with the economy, but it really is as simple as supply and demand is what drives the big, price increases and price decreases in housing. And it really took inventory growing up to over 15, 18, 20 months of inventory before we started to see significant downward pricing in 2017. When someone can't sell their home for 3 or 6 months, they're less willing to do a price decrease as someone 6 to 9 months, 12 months, 18 months, 24 months. That's where the hurt really starts to happen. And we're still at 2.6 months and falling, even though we're up a little bit year over year. We're still 1/5 of where prices were, 1/5 of the inventory where prices started to fall in 2007. So I kind of digress back to the pricing discussion. But this is why we are not running for the exits as far as saying, oh, a big price correction is coming. Wait, there's going to be a massive buying opportunity. We just don't see that. So speaking of running for the exits, everyone's talking about recession in the headlines, right? Eric, you wanted to jump in on this one?
Yeah, I'd be happy to. I mean, I think a couple just really key points to that, the recession piece of it is when you do look back at historical, recessions that we've had, there were just so many different factors in play. And in particular, in this one, some of the items that we've just spoken about, interest rates and lending and purchase power and so forth, are certainly key pieces to that. On the other hand, because of the lending practices that are in place now versus 2009, 10, 11, are really much tighter. Credit scores need to be better, the kind of big picture. So, when you compound, needing X amount of money down plus the equity position that people have, they're generally sitting in a position of not feeling like they have to turn the keys in, in terms of just that confidence in the market. The second one being, the average equity, Jacqueline hit on it real quick, the average equity in a home in the United States as of March 1st was 300,000. So it's really significant. It plays a huge role in how confident someone feels about their real estate investment and holding on to it, or for the other side, getting rid of it. So that part of it, I think, is not going to be a knee-jerk reaction in the real estate market. And then, the other part, I think that you got to look at big picture outside of even, the lending practices is about 30 to 35% of homes in the US are owned via cash. So it's not burning a hole in their pocket, even if it's an investment property. So that part of it, and now from a kind of big picture, national scale, our employment rates are really strong right now. Unemployment's 3.5%, and interest rates are coming down, but it's not like they're coming in a flood. It's kind of a balance, and we certainly have seen over the last 6 months, when we do have some continuity to those rates, we see a bump in activity and a bump of people kind of entering back into the market.
Yeah, perfect. And then, we're really in the balancing act right now where the Fed is going after housing in the sense that they know that a big part of inflation is housing costs right now. So they were absolutely trying to get ahead of that housing run that we had of 20% appreciation a year. And they put a stop to it. And thank goodness they did, because we were headed in a point of unsustainable footing that would have led us to a more precarious situation. And now we're in the dance, and sure, the Fed's going to try to tamp down housing, appreciation a little bit more, but there's so much resilience in the market. There's such a shortage in the market. We're kind of at that dance point, and it's going to remain that way for some time, I believe. But then, to answer the simple question, people are saying, okay, if we are going into a recession, Eric, does that mean housing prices are going down?
No, it doesn't. I think from a just like I was mentioning, confidence perspective of where we're at and where real estate is in an investment, there's still a level of confidence, and the numbers and statistics behind it, whether it is equity or interest rate, people are still feeling like it's a good bet, and I don't want to call it a bet, but a good investment. And the recession as a whole, we're still seeing it level off, and we're not seeing big drops. And would it impact it? Like I said, the numbers don't say it is. In terms of where we're at, like this is a good graph in terms of 2008 and 2020. The delta there is still pretty minimal from a big picture perspective.
Yeah, and then, generally because the Fed tries to pull us out of recessions, we start to go into the inverse of what we're seeing right now. And generally, the reason housing prices are also resilient during recession is that the Fed's savvy. They understand that house sales, house constructions drives a lot of jobs, gets the economy going again. And generally, that's driven through lowering interest rates. So on the backside of what's happening right now, if we do fall into recession, generally the Fed has to start inching back on these interest rates, which is what we've seen in all these 6 last recessions that we've looked at, right?
Yeah, yeah, absolutely. And that's what I was trying to get there. And not I was trying to kind of relay that we aren't seeing that downward pressure in such a significant way by the Fed yet. That says that, we're scared, or we need to recede on the rates because of the other conditions in the markets, and where we are with unemployment and where we are with the GDP and so forth. So it's and there is room to move there. If you look back at the national average over the last 30 years, 5%, low 6% isn't actually that far off.
Yeah, perfect. So, I guess with that, let's jump over to the kind of, what we rarely talk about interest rates this much. It feels like we're myopic on interest rates, but it really comes down to the macro perspective of we have a housing shortage. There's not enough homes for sale. We have a housing affordability issue, which is kind of dampening down demand a little bit, but we have such a massive shortage. It's really, the activity right now is more closely linked to interest rates than we've seen in the last 20, 30 years, right? I mean, Alice, I'd love for you to jump in, all you guys to give your opinion on this one as well.
Absolutely. I'm gonna kind of take this in 2 directions. So obviously I've talked about, how it's affected the buyers that are dependent on mortgage interest rates, where they're really looking at, I have X amount of money to spend every month. What is the most house I can get for that? So they've been affected greatly in this kind of climate with all the interest rates. But the other part of it that we haven't really talked about yet is my cash buyers. So there has been a really good opportunity for negotiations, with people who have the ability to purchase cash, because a lot of buyers just don't have the ability to afford homes if they have to, do a mortgage, or they're asking the sellers for a contribution towards their buy down so they could keep their monthly payment affordable. So we've been able to do some pretty good negotiations on the cash side of things because they're not as dependent on that. And I've also had some clients, talk about instability and recession, but instability in the stock market and that whole situation. I have folks that have also pulled money out of the stock market. Although it is down from where it was peaked, they've had that money sitting in there for a long time, and they're up 400% from, where they started, and they felt comfortable pulling money out and getting a really good price and kind of parking their money into something that they felt was a little bit more stable and safe. So it's been interesting that's kind of affected, interest rates have really affected cash buyers as well, because it's given them a little bit more opportunity.
Okay, so this was a graph that was put together by KCM, where they feel, and we're pretty in line with this, is that right now the activity that we've seen over the last year has really been driven by interest rates. Interest rates go up, buying activity goes down, interest rates go down, buying activity goes up, just because we're on that cusp of affordability. So what I'm hearing is cash buyers, there's a buying opportunity while interest rates, people are waiting for them to come down, right? But we're trending in the right direction for the time being with those rates, right? And we think that demand is going to continue to grow here in the next 1 to 2 quarters. Fair?
Absolutely. Yeah.
There is. I just wanted to point out one thing too on that last slide was there was a note in there about builders decreasing production, and I think it's important to note, their overall, practice in terms of slowing down production. They're not stopping. I think there's this mentality that, builders are scared and they're not building, maybe as much, or they're building very little, when in reality, this slowed their pace down a little. And, if you looked at the national average, they definitely are doing that. Building permits are down. On the other hand, that is what is also driving some of the demand for these neighborhoods, and that there's less to choose from. So when people roll in and they're really ready to look and ready to buy, they still have options. And they may have a few, less options, but on the other hand, the builders are still willing to build those homes if the buyers are willing to wait. They'll build them. They'll just, once they have a contract, then go. So that, Brian, you mentioned kind of there's a lag, and that is also part of our lag, in terms of like how people are getting properties under contract and how long they might have to wait to get them.
Yeah, absolutely. Good point. And then you have down there, which you talked about before, of right now we're seeing pending contracts outstripping new supply in a time where generally in the spring, inventory is growing dramatically. So some of the synopsis points that we've talked about, historically low inventories providing resistance to the large price correction that a lot of people were calling for. 6 months ago, the headlines and everyone was screaming in our ears that the world was ending. It was irresponsible to be involved in real estate. And we've seen some softening there for sure. And we're not saying that the softening is 100% done. But what we're seeing is that we just don't have the inventory for that rug to be pulled out like we saw in 2007. With this low inventory and housing affordability constraints, the current buyer demands are largely dictated by interest rates. I feel like we're beating a dead horse there, but that's what we're seeing. And this correction in pricing that we're seeing isn't really a supply and demand. It's really being driven by the Fed driving down inflation. They're going after inflation and they're trying to stop that. And with these extremely high mortgage rates, and it's not the oversupply or the weakening demand for housing. People want houses. They just can't buy them right now. And then, the greed is gone. We're seeing a return to normalcy a little bit, right? And so in our buyer and seller consultations, we're going back to the basics. We're creating a plan. We're saying don't buy because others are buying. We don't sell because others are selling. Figure out what your plan is, how we navigate this, buy what you can afford. If you can't afford it because of these high interest rates right now, maybe rent, maybe sit on the sidelines, maybe put together a plan, maybe look for opportunity in the off markets when others are, fearful of the headlines, or the fall and the winter when no one else is shopping. Some people are saying, hey, you marry the house, you date the rate, buy the house, and hopefully refinance later. I'm a little wary of that in the sense that I don't want people to buy a house they can't afford. And if they lose their job, they're going to lose their house. But there are some ways to do 2-1 buy downs, like Jacqueline was talking about. There's some ways to navigate it, but make sure to stay within your buy box. And then the big thing, which we always stick with, is long-term outlook. We saw a lot of people get hurt in the recession, but anyone that could hold on 3-4 years, they were made whole. And housing has remained a strong part of their portfolio, their life, their financial security, their family security. And that's where we like to firmly stay when we're helping advise our clients. But thank you. I don't know how much time we used today. I think we went a little bit long. I apologize. Eric, Jacqueline, Alice, thank you so much for joining us today. You guys are the best in the biz, and I would hate to negotiate against you. But do you have any parting thoughts to answer?
I did just want to respond to Drew. This has been on my mind since I saw the question pop in. And so, Drew, your question was, do you feel like remote workers are going to be pulled back to the market? And I think about this a lot. And Brian, you showed, the inventory of the right before the recession hit in 07, 08. And I was not personally here in Bend at the time, but the world, the working world, the internet, all of our connectability was a completely different place. And I heard you say, Brian, that you kind of were hoping for a little bit of that so that we can maybe add some more inventory. But what I'm seeing and hearing is that there are enough remote workers, nationwide, worldwide, that want a home in Bend to work out of, and that the workplace is so different that if they, get let go of their job where they have to go back in the office, they're going to move elsewhere. So yeah, I don't know. I just felt like it was worth mentioning. I feel like Bend has come a long way in the remote working world.
Well, it's also Bend had a big sector of remote workers well before the pandemic. And a lot of people forget about that, but I mean, I had people moving here in 2015 that were remote workers. So we're not just pandemic remote workers. I think it's been a thing here, and I don't think it's going to completely flood out.
Yeah. Yeah, before the pandemic hit, there was the article about remote workers flying in once a week to San Francisco because it was cheaper than commuting. It was like, yeah. And another
Yeah.
one about top 2 remote workplaces in the world.
Yeah, it's a good place. I mean, we have 6 flights a day down to the Bay Area as far as that goes. Compared to the traffic, I actually drove through San Francisco a couple weeks ago, and I think it would take longer to drive across the Bay Area than it is to fly to Bend. So unfortunately, I don't think the crosshairs are off for Bend being a desirable place to live. So, well, anyways, thank you all for your time. And if
Yeah,
anyone
thank
has
you.
any questions, please
Thank
send
you.
us an email. We're always here for you. Take care.
Thanks. Bye-bye.
Bye.